Introduce about international payment. Hello everyone, what do you think about international payment? Or what is international payment? In this video we will discuss about the concepts of international trade. Firstly, I will introduce to you the objectives of this video. It means, after watching this video, you can explain the definition of international payment. The second objective is that you can understand the jurisdiction and customs in international payment transaction. And the last one is that you will be introduced of correspondent banking operation of commercial banks. To get 3 objectives above, the chapter will be divided into 4 following sections. Definition of international payment. In this section, you will explain what is international payment, and then we will find out the characteristics of international payment to economy, to exporter and importer. The third part is applicable rules or jurisdiction used in international payment transaction. This part is quite important because you should be aware about the rules applied in a transaction to protect yourself. The next part is correspondent banking operations. The operation of commercial banks can help banks providing the international payment services for their customers. Firstly, let's explore what is international payment. Companies engage in international trade transactions for various purposes. Maximizing corporate value by increasing revenues and profits will be the ultimate goal for most companies. Companies engaging in international trade transactions are likely to gain more revenue and profits. On exporters' point of view, they want to make certain that they will receive payment once they have shipped goods, and in perspective of importers, they want to make sure they will receive the goods once they have paid. How can both exporters and importers achieve this win-win situation? In international trade, it is important to ensure payment from overseas buyers. The method of payment determines how payment from overseas buyers is secured. International payment refers to the transfer of funds between parties located in different countries. These transactions are executed through financial institutions such as banks, payment processors, and specialized payment networks. It encompasses the fulfillment of financial obligations arising from both commercial and non-commercial activities between individuals, organizations, or nations through the banking system. International payment refers to the transfer of funds between parties located in different countries. These transactions are executed through financial institutions such as banks, payment processors, and specialized payment networks. It encompasses the fulfillment of financial obligations arising from both commercial and non-commercial activities between individuals, organizations, or nations through the banking system. And now we will discuss about the importance of international payment. The first importance of international payment is it can facilitate trade. International payments enable businesses to purchase goods and services from suppliers in different countries, expanding supply chains and accessing a broader range of products. The second one is international payment can also promote investment. These payment systems allow businesses and individuals to invest in foreign markets, fostering economic growth and diversification on a global scale. About the types of international payment transactions, it can be divided into the following types. Trade finance, payments associated with import and export transactions. Remittance, personal payments sent by individuals abroad to their family or friends. Foreign investment, payments made by investors to establish or acquire businesses abroad. Each type serves different purposes in the global financial ecosystem, facilitating various aspects of international economic activity from personal transfers to large-scale business investments. There are many types of international payment methods in the market. However, in this video, only some popular payment methods are introduced, such as money remittance, can be called as wire transfer, collection, and documentary credit. Money remittance. This is an international payment method, the direct transfer of funds between individuals or entities from a country to another abroad. Collection, including methods like documents against payment, DP, Documents Against Acceptance, DA, and Documents on Trust, DOT. Documentary credit, this is a form of payment guarantee, often used in international trade. These methods vary in terms of speed, security, and cost, catering to different needs in international transactions. Which factors can affect the international payment? The first one is security concerns of buyers and sellers. Ensuring secure payment processing is crucial, especially for large transactions or when dealing with new partners. This involves implementing robust verification and encryption measures. The second one is contract size of the international sales contract. Larger transactions may attract higher fees and require specialized payment methods. The size of the contract can influence the choice of payment method and associated costs. And the last one is the different regulatory frameworks between countries. Regulations vary across countries, affecting payment procedures, fees, and compliance requirements. Understanding and adhering to these frameworks is essential for smooth international transactions. Whenever disputes arise out of an international trade transaction, there is the question of which country's law to apply. An international trade transaction is governed by the national laws of a specific country. If a court decides that it possesses jurisdiction in an international dispute, then a further question, concerning the choice of law, must be considered. First, the choice of governing law in an international trade transaction will usually be made by a contract clause in a specific sales contract. Second, such choice of law may not be recognized by the court. In a specific dispute, the governing law is finally decided by the private international law of the competent jurisdiction. The governing law may be decided by an international convention or rule, if any. These frameworks provide standardized rules and practices for international financial transactions, ensuring consistency and reducing disputes in global trade. Correspondent banking plays a crucial role in facilitating international financial transactions. It enables banks to offer their customers access to global markets and services, providing convenience and efficiency in cross-border payments and trade finance. A correspondent bank is a bank that provides services on behalf of another, equal or unequal, financial institution. It can facilitate wire transfers, conduct business transactions, accept deposits, and gather documents on behalf of another financial institution. Correspondent banks are most likely to be used by domestic banks to service transactions that either originate or are completed in foreign countries, acting as a domestic bank's agent abroad. Correspondent banking is an operation where banks establish relationships with other banks in different countries to provide banking services to their customers. This system enables banks to extend their services abroad, process payments, manage accounts, and provide trade finance services for clients in different countries. It allows banks to offer seamless and cost-effective international transactions to their customers without the need for direct branches in every country. You can see the correspondent banking process on the screen. The first step is choosing a bank abroad to be the correspondent bank. It should be the high reputation and popular bank in foreign country. The second step is negotiation the correspondent banking contract. After that, banks will open account at Correspondence Bank. These account banks are called Nostro and Vostro account. And finally, banks will provide correspondent banking operation under the terms and conditions in correspondent banking contract has been signed. So what is Nostro account and Vostro account? Nostro accounts are accounts maintained by a bank at correspondent banks to facilitate payments and transactions. They are typically denominated in the currency of the country where the correspondent bank is located. And Vostro account, sometimes are called as Loro account, these are accounts of correspondent banks maintained at the bank to settle transactions. From the perspective of the correspondent bank, this is their Nostro account. The correspondent banking operations brings many benefits to commercial banks such as expanded reach, widens customer base by providing services in international markets. Reduced costs, eliminates the need for direct branches in foreign countries, reducing operational costs. Enhanced customer service, offers more comprehensive and efficient services to clients with global needs. Improved efficiency, streamlined processes and simplified procedures enhance the overall efficiency of international transactions. These benefits make correspondent banking an essential component of the global financial system, facilitating international trade and financial operations. Let's take a look at the SWIFT system. SWIFT stands for Society Worldwide International Financial Telecommunication. Through SWIFT system, banks send messages called SWIFT messages to other banks to communicate. Such SWIFT messages are encrypted, so they are very reliable. As we discuss above, the international payment is made through banking system. However, banks are in different countries, and each country has different languages, different custom, and different practice. Therefore, it is very important to ensure there is no misunderstanding in communication between banks. Hence, there is indeed a common protocol for such communication, and nowadays, SWIFT system is easy and reliable that banks can communicate with each other. The SWIFT system can standardize message. SWIFT uses a standardized messaging format, ensuring consistency and interoperability between participating institutions. The system protects sensitive financial information and transactions from unauthorized access. SWIFT's extensive network provides a global platform for financial transactions, and its automated processes streamline financial transactions, reducing processing times and costs for institutions.